Welcome back to CEO Money. I'm Michael Yorba. Thanks for joining with us. I have Mish Schneider, Director of Trading, Education, and Research at MarketGauge.com with me today. Mish, welcome back to CEO Money.
Thank you, Michael. Great to be back once again.
All right. I'm going to open this up to where when you actually called the top on the market here. We were looking at several indices, but one of which I want to bring out to point. On the 7th, when we were speaking, was the last rally, just about 2,800, a little higher than that, but not much, on the S&Ps. I marked it on my charts, and now we're 2658 right now. We've got a lot of markets to go through. I wanted to find out, number one, congratulations on the timing. Couldn't have been any better.
Thank you.
One of the questions that comes up is this a exhaustion flush, what's going on today with opening about 500 points lower on the stock, on the Dow, or is it a potential breakaway gap and there's more to come? So on a high level, before we drill down into the rest of the stocks that we're going to talk, or the indices that we're going to talk about today, answer that for me with what your opinion is.
Well, I think that the flush that we saw yesterday and then again early this morning was a flush only because of the fact that tomorrow people will start to disappear as the Thanksgiving weekend takes hold. And even though Friday is a half a day and the market is open, for as long as I can remember, it's been an incredibly slow session because they're waiting for Black Friday sales. And so it doesn't surprise me that we might see a little bit of short covering ahead of that, but that is very different than, is this the bottom? So at this point, I'm going to say, I wouldn't necessarily want to go short right here, but if you're going to do anything in terms of buying, I would look at it as a day trade, maybe a 3-day trade with a very tight stop, because I think we're going lower. We're not done yet.
Okay. Are any of your indicators giving you a projection of how much lower? That's the next question on everybody's head. How much time and price future?
Well, what's interesting is all of the indices today held the lows that we had about 3 weeks ago when we had that first big flush, except for NASDAQ. NASDAQ actually broke it and then came back through. The market has been so incredibly technical. It's really amazing. Last week's low, for example, in the S&P and using the SPY, the ETF, was 27 or 270. Excuse me, 267. And so today's high so far has been 267. However, the low of the move was down at 259.85. So right now, we've tested last week's low, haven't been able to go through, but yet we haven't broken down under the low from 3 weeks ago. So even though we did in NASDAQ, for the S&P 500, we haven't. So if we just want to play the technical game, we don't have to look at all the indices, but let's just pick the SPY since we're talking about it.
Okay.
If we can get through 267, I think that would encourage people maybe to start putting their feet in the water for testing some of the stocks that they're interested in. But if it doesn't get through 270, what has it really done? It's just had rallies that have become shallower and shallower and shallower. If it doesn't get through 267, then I would say that that's probably a good indication that the low that we had more recently at 259.85 is going to be at least tested and if not taken out. But clearly, at this point, the only way I'd be willing to say the low is in place if we see the classic signs of what we look for a bottom.
Okay. All right. IWM.
Okay, well, so IWM also had a low about 3 weeks ago at 144.70. And today's low, I think, was 145, excuse me, let me look, 145.59. So again, it didn't quite get down to the low of where it was, but it too had a very pivotal level at 150. And right now, if we can't get through 150, it's really pretty much a mirror of what I just said about the SPY. It means that the rally is even shallower, and so we're not really at the point yet where enough people have liquidated or the bias is negative enough, and it would probably need another leg lower, whether it takes out that 144.70, which doesn't seem all unlikely considering the low today wasn't that much higher. And then where does it go? And, there are some monthly moving averages to look at, but right now IWM is below that. So if that, again, as I always like to use it as an early indicator, means something, it means the others are probably going to wind up breaking them too, unless some miracle happens.
Okay. QQQ. NASDAQ.
Well, let's talk more about the FANG stocks because we've been talking about that every week. And so now there's an example where, and it's so interesting, Apple is still now still red on the day, but Netflix turned green, Google turned green, Amazon was green. Let's see if it still is. I can't find it on my screen. Yes, it is green, and Facebook, which was green, is now red. So, the NASDAQ is going to be really impacted by that. From a fundamental standpoint, Facebook still is facing a lot of trouble. From Jeff Bezos has gotten a tremendous amount of criticism about his choices of where he was putting, expanding Amazon warehouses. So, and then, Apple has just really have had trouble because in terms of the iPhone, people aren't upgrading the way they used to. And of course, obviously, that's a big reason why that's down. So NASDAQ, which was the amazing thing that everybody wanted to own, now is looking like it's in trouble. So even though this morning it was the only one who made new lows from 3 weeks ago and it's floundering around, I think that these rallies in these FANG stocks do not sustain. Again, another major leg lower is probably in store.
Target.
Well, if I'm just going to reach over here so I can tell you what the monthly moving average is in NASDAQ, so please forgive me for that.
Sure.
I like to tell people, though, that, we're kind of in the war room here. And you can sort of see behind me the situation that we have with all the monitors and everything. So I'm talking to you on one computer, but my trading computer is a little bit further away. Okay, so 155.50 in NASDAQ is the 23-month. And it's got a strong upward slope on it. So even if it took out 155.58 and then dipped below but closed the end of November above it, that would maybe look more encouraging for December. But if it doesn't, then I think we can look all the way down to 150 at that point.
Okay. And if it really gets out of hand, I'm looking at 115 on my longer-term monthly charts because that seems to be a real support area. But we're a long way off from there.
Oh, my God. And that would be very, very ugly.
It's happened before.
Absolutely. It's so interesting. I watched on Saturday, even though it's the weekend, and when you're a trader, you sort of have one eye on what's going on in the world at all times. So I was watching Twitter, and it was amazing how many people were getting bullish over the weekend. And and coming up with all this evidence, technical evidence, fundamental evidence. And I was really scared for the people who have followed these people over the last 10 years during a bullish market and have looked like geniuses, now really being irresponsible to people who are vulnerable, thinking, hey, I followed this guy for 10 years. Then why wouldn't I do that now? Putting a bullish chart after bullish chart. Now, hopefully, with the opening yesterday, people just got scared and didn't get long. But it's really interesting how few people out there really understand what a bear market looks like. Maybe they remember 2008, but even that was relatively short-lived, as damaging as it was. It was over by the spring of 2009.
Well, we've got an entire generation that's never lived through one. That's now starting to get a paycheck and I'm putting the money in the market.
Exactly, and also have never lived through inflation. That's the other thing. It's so interesting because 2019, by the way, is the 10-year anniversary of when I joined Market Gauge. That's number one. And it's also the 40-year anniversary of when I was introduced to commodities. I was a very young girl that walked down on the Commodities Exchange in 1979. And I walked into, and I think it's kind of ironic, 40 years later, hyperinflation. So, not that I'm going to hold a lot of credence into anniversaries, but I have one eye on that potential happening for 2019.
I got it. I'm looking at the QQQ on the daily basis right now, and I know that It just doesn't look good to me. If it can't close, I agree with you. It can't close over that October 29th low.
Which was what, like 162 something?
So let me see here. It was like 160.09, I think it was, yeah.
Okay.
On the QQQs. If it can't get over that baseline, and right now it's having a lot of trouble with it, I think it's going to get kind of ugly after Thanksgiving, or going somewhere in that range. But again, the show's about you, not me trading. IYT.
Okay, so I'm going to go back to my charts here. So excuse me once again, and I have to figure out a different system for not having to lean over. Okay, so IYT, I think when we spoke last week, we said that it was probably the best hope, if there was going to be any kind of rally, that would get back over like 193, 194. And as we know, it didn't. So now it's underneath the 50-week moving average for several weeks now. But we do have triple bottoms down at around 175, 176.
Right.
So that would be a target, which it looks like it's going to get down to again. If it holds, it's possible that we can see the bounce from there. But if it doesn't hold, then it's really going to get ugly too. And it can go all the way down to around 162. Where it meets the 200-week moving average. But more importantly, let's talk about why I focus on IYT.
Sure.
It's transportation. And, if we're going to look at IWM as sort of the best indicator for supply, then we're going to look at transportation as the best indicator for demand. And if the demand is getting crunched, I don't care how wonderful Black Friday is going to be, household debt has increased by 17%. Over the last several years. That means that A, people are going to pull out their credit cards if they're feeling like spending a lot of money on Black Friday. And B, if they don't, how is that going to affect the whole December Santa Claus rally? Do we have one or not this year? So that's why I like to look at IYT, because that will give a reflection if people are buying, and then if the demand is increasing. And if it's not, that's not a good sign.
Okay, so the line in the sand, 175-ish?
Yeah, 175, 176. We had a low there in February when we had the 10% decline. And then we had the low there about 3 or 4 weeks ago when we had that October low.
I agree with you 100%. If we don't see demand pick up on this, then that bodes for all of the doomsdayers to say it could be here now, because people have been trying to short this market for quite a while. And now that it's here, the dry powder is going to come out of the closet, and they're going to be able to do this with enthusiasm.
Absolutely. They will definitely get bolder. There's no doubt about it. And people who don't know how to short the market, or are afraid to short the market, or can't, because some accounts put restrictions on that, and don't know about wonderful things like ultra shorts where you can actually buy. So like, for example, if you want to be short SPY, you can buy SDS, which in essence makes you short. It's a way, as a loophole in getting around not being able to short in certain types of accounts. Those things are just going to go, they've been under pressure for years as we've gone through this bull market. They have a tremendous amount of upside, which means the market has a tremendous amount of potential to the downside.
I agree with you, and I'm looking at it right now on, I use different stuff than you, but it seems to me that it just bounced right back up to a 50% retracement off of that low, which this is a classic of the end of October, and stopped and turned. And it went underneath my averages. I use slightly different averages than you do. It's beneath everything right now. This is looking like it could get really ugly.
Yes, and how does that impact some of the policies that are in place, starting with the Federal Reserve? Will the Federal Reserve pause on increasing their schedule for raising rates? Possibly. What does that mean? That I don't think would be taken as a good sign for the market, number one, because Powell's been banging the table about how strong the economy is. If he all of a sudden is tempering that philosophy, what's the message there? And of course, we've talked about this too. If he actually starts easing, which I don't believe he will, I think if anything, he would just keep everything sort of status quo with the rates. But what does that do for the potential of the inflationary scenario that we've been talking about, the potential 40-year anniversary coming up in 2019. I mean, so that's one policy. The other would be these tariffs and the trade wars. Would the administration roll those back? That would certainly give a good boost of adrenaline to the market. But at this point, we're showing really no signs other than the incredibly recycled false news about China coming to the table, which has not been substantiated at all at this point.
I agree. Let's step. Okay, we just went through transportation on the ETFs. Now let's talk about, because that one's looking bearish to me. Now I'm looking at the XRT.
I'm so glad you brought. Yeah, I'm really glad you brought that one up, because I remember when we talked several weeks ago, we said if there was any beacon of light in the market at that point, it was going to be because of brick and mortar retail, given the seasonality. Well, instead, it's done exactly the opposite. It actually collapsed over the last couple of days, and now it's broken down under its 200-week moving average. This is a really clear to me, if you want to talk strictly technicals. Mm-hmm. If you wanted to say, gee, maybe we're going to see a December rally, at this point, XRT underneath 45, that would not tell me that it was going to go down up anymore. It could go back down to 43, which again was double bottoms back in the early part of 2018, that is. Right. If we actually clear back over 45 and hold, then at least we might see some rotation back into some of the retail market. But right now, again, it's sort of in between. Betwixt and between, we don't know.
We don't, but we're both students of classical charting. And in gap theory, you've got a breakaway, continuation, and then an exhaustion. Today, we had a continuation. So it tells me there could be one more bump lower. And it also, since these are leading indicators of what's happening with price, that we may not have, just a guess, but we may not have recovery in retail as we go through the Christmas season, because this is looking, again, a little bit more bearish than every time we look at it.
And, you know, the stores are getting more and more desperate, and I say desperate because the Black Friday sales, so many of them have already started. They're not even waiting for Black Friday anymore. They're trying to entice people to come in and buy. And obviously, I would think that if you read between those lines, it means that the retail sector is extremely nervous. They've been laying off right and left, and even though they had some initial trouble finding temporary help, as they usually do, hiring for December, for the pickup, I don't think that there has been a tremendous demand for hiring in some of those big chain stores.
Yeah, my interpretation on this, in line with what you just said, is that the forward-looking statements that the analysts are giving, the in-house analysts are giving to these stores, it's not looking good. It's the preemptive online sales are probably telling these brick and mortars that it ain't going to be such a good Christmas, which makes me think maybe we won't get a Christmas rally this year.
If we don't get a Christmas rally, I'm just going to really feel badly for a lot of people, for the people who work at the malls, for the economy, for the consumers who did go into increased debt thinking that maybe they'd be able to work themselves out of it. You know, it would not be a pretty picture all around.
Okay. Semiconductors?
Well, you know, the semiconductors were one of the first to crack. And it seems like SMH, which is that symbol, loves round numbers. So it never got really through 94 was the first round number. And then 90 was another big area for it to hold. And we got below it this morning, and now we're trading right above it. So again, it didn't reach the low that it had 3 weeks ago, the October low, but it got pretty darn close this morning, and now it's popped over 90. If we were going to say that the technology sector or the semiconductor sector is going to try to make any kind of run for it, it has to get through 94, 95. And if it doesn't, then again, that also has a lot of room to the downside with its 200-week moving average well below at around 75, 76.
Yeah, I'm looking at the weekly chart. Okay, well, people better start bracing themselves. All right, let's look KRE.
Now, that's also a really important sector because it's tied with XLF, so it's big banks and regional banks. And when the rates were going up, it never really followed along, which you would think that the banks would actually like the fact that the rates were going up because they make more money that way. But it didn't. And, obviously there were other reasons, mortgage rates going up, borrowing becoming less, debt going up, et cetera. So if we're looking at KRE, it really was the first one of those sectors that I watched to break down. And so now it's well below its 50-week moving average and not too far from its 200-week moving average. So that's at 50. So let's say if KRE cannot take back 55, we're looking next at 50. That's also was the low at the end of 2017 before it took off. And then we can have another discussion to see what's going to happen from there.
Great. Off this last rally that we had back October 24th-ish, it only retraced 38%, 38.2%. Exactly like you were saying earlier, these markets are performing almost like a machine is saying we got to go to this point and stop. It's exact.
It's so technical.
Yeah.
And if you're just patient and wait for those spots, you can get a good day trade out of it, or you can get a day trade that extends into more. And if you know how to do good trade management, maybe you can actually make a little money on the bounce. And if it fails and you know how to go short, then, obviously, as they say, stairs up, escalator down.
We're living through it. Okay, the IBB.
Now, biotech is completely broken down, except for one thing. Right now, it's below its 50-week. It's below its 200-week. It's sitting right on the 23-month, and it's had many bottoms. And I'm talking about from 2017 to now. It's had, I'd say, probably 6 or 7 attempts at 100, and has held. So there's your magic number. Either it gets back over the 200-week at 105, in which case you can say, all right, my risk is to 100, and it keeps going up, and we get some new specs and a little relief in the market, or it doesn't get through 105, breaks down under 100, and it's very, very sloppy from that point. Plus, again, like KRE, IBB had never made new highs this year the way so many of the other sectors had. It's been lagging.
I'm looking at this 100 level, and you've got a low on February 8th, you got a low on April 6th, you got another low on May 2nd, the most recent, October 26th, and then today. It's hit this low 5 times, today including being the 5th time. I got an issue. If this thing breaks loose, it's going to be a just complete turnaround for this industry sector. I mean, that is, Katie, bar the gate or bar the door. This thing could cascade.
Well, the reason why it's in the Modern Family, by the way, is because it's I consider it to be the most highly speculated area to trade. Biotech. People often put a lot of money in there, hoping that some pharma company comes up with a trial that gets approved by the FDA, and they wake up and the stock is up 25%. Obviously, research and development in biotechnology is not going to go away. However, what it's telling you now is that the specs are nervous. And like you said, if it breaks down under 100, it will be yet another level to get very, very defensive about in terms of the market.
Would you mind taking a look at BKX for me? Because this is the bigger banks. There's smaller regional banks, and then there's bigger banks. And it looks like the bigger banks are going to get hit with some kind of another problem, and I suspect that's going to be some kind of a debt default. Just looking at it.
The debt is incredible. I just did an article about this, so I mentioned household debt. There are 6 million people in this country right now who are more than 90 days late in paying back their car loans, and there's been a lot of car loans that have gone bad even before that. Student loan debt is huge. And then the really big pickle is the fact that we have a $23 trillion debt in the country, and a lot of countries like Russia has already stopped buying our debt. China has also stopped buying our debt, or at least Russia went back down to almost 50%. China's scaling off. And among the other countries that typically buy our debt, that's also way down. So, right, what's that? That is definitely going to affect the banks. I think what's so interesting is that Buffett doubled up on his long position in JP Morgan and was very vocal about it. Not really sure what he's thinking, but, you know, he might just be out of touch at this point. And who am I to say that about Warren Buffett? But still, I just think it's really, he doubled up in Apple near the highs, and now he's doubled up in JP Morgan.
He's got to have some exit strategy in place because this doesn't look good either. Okay, well, you never know, because Apple was not a good play.
No.
I mean, that was it. All right, Mish, thanks so much for being on the show. I can't wait to get another update. But at this point, my takeaway from this is stay the course. And until otherwise, it looks like the smarter traders are selling strength.
Absolutely. I mean, I saw a pretty funny quote yesterday. Somebody said, people say follow the smart money. Well, if the smart money was so smart, they would have been selling a long time ago. But, you know, it's interesting because the institutional are made up of passive investors. And, you know, that's really where I have my most concern, is talking to people, friends and family members who just put their head in the sand and say, the market always comes back. If I just wait, I'm going to be fine. And as we know, there's that potential where if it could be, just go back to the 1929 crash, even though it had a rally from 1933, it didn't really come back until 1954. We would hate to see that happen, especially to the baby boomers who have their retirement savings tied up in IRAs and 401s and can't get out.
Well said. All right, Michele.
But I just want to end on a positive note. I just want to say happy Thanksgiving, and remember the things that we are thankful and grateful for. And one of them is the stock market, because it actually is the truest bastion of pure capitalism. Anyone can trade it. And if you give yourself an education, you can make money in bad times. You can make more money in good times. And it also gives you a real snapshot of the sentiment of the economies, both here and around the world. So I'm very grateful that this is the business that I've chosen. I just wanted to say that.
And I'm grateful you were on a show with us today.
Thank you. Have a wonderful Thanksgiving, Michael.
You too. You've been watching CEO Money with Michael Yorba. Thanks for watching with us. Follow us on Facebook, like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel.